my colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Our economy is strong overall and has made significant progress toward our goals over the past 2 years. The labor market has cooled from its formerly overheated state. Inflation has eased substantially from a peak of 7% to an estimated 2.2% as of August. We're committed to maintaining our economy's strength by supporting maximum employment and returning inflation to our 2% goal. Today, the Federal Open Market Committee decided to reduce the degree of policy restraint by lowering our policy interest rate by a half percentage point. This decision reflects our growing confidence that with an appropriate recalibration of our policy stance, strength in the labor market can be maintained in a context of moderate growth and inflation moving sustainably down to 2%. We also decided to continue to reduce our securities holdings. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP rose at an annual rate of 2.2% in the first half of the year, and available data point to a roughly similar pace of growth this quarter. Growth of consumer spending has remained resilient, and investment in equipment and intangibles has picked up from its anemic pace last year. In the housing sector, investment fell back in the second quarter after rising strongly in the first. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In our summary of economic projections, committee participants generally expect GDP growth to remain solid, with a median projection of 2% over the next few years. In the labor market, conditions have continued to cool. Payroll job gains averaged 116,000 per month over the past 3 months, a notable step down from the pace seen earlier in the year. The unemployment rate has moved up but remains low at 4.2%. Nominal wage growth has eased over the past year, and the jobs-to-workers gap has narrowed. Overall, a broad set of indicators suggest that conditions in the labor market are now less tight than just before the pandemic in 2019. The labor market is not a source of elevated inflationary pressures. The median projection for the unemployment rate in the SEP is 4.4% at the end of this year, 0.4 higher than projected in June. Inflation has eased notably over the past 2 years, but remains above our longer-run goal of 2%. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.2% over the 12 months ending in August, and that excluding the volatile food and energy categories, core PCE prices rose 2.7%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The median projection in the SEP for total PCE inflation is 2.3% this year and 2.1% next year, somewhat lower than projected in June. Thereafter, the median projection is 2%. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. For much of the past 3 years, inflation ran well above our 2% goal, and labor market conditions were extremely tight. Our primary focus had been on bringing down inflation, and appropriately so. We are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. Our restrictive monetary policy has helped restore the balance between aggregate supply and demand, easing inflationary pressures and ensuring that inflation expectations remain well anchored. Our patient approach over the past year has paid dividends. Inflation is now much closer to our objective, and we have gained greater confidence that inflation is moving sustainably toward 2%. As inflation has declined and the labor market has cooled, the upside risks to inflation have diminished and the downside risks to employment have increased. We now see the risks to achieving our employment and inflation goals as roughly in balance. and we are attentive to the risks to both sides of our dual mandate. In light of the progress on inflation and the balance of risks, at today's meeting, the committee decided to lower the target range for the federal funds rate by a half percentage point to 4.75% to 5%. This recalibration of our policy stance will help maintain the strength of the economy and the labor market, and will continue to enable further progress on inflation as we begin the process of moving toward a more neutral stance. We are not on any preset course. We will continue to make our decisions meeting by meeting. We know that reducing policy restraint too quickly could hinder progress on inflation. At the same time, reducing restraint too slowly could unduly weaken economic activity and employment. In considering additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as expected, the median participant projects that the appropriate level of the federal funds rate will be 4.4% at the end of this year and 3.4% at the end of 2025. These median projections are lower than in June, consistent with the projections for lower inflation and higher unemployment, as well as the changed balance of risks. These projections, however, are not a committee plan or decision. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we can dial back policy restraint more slowly. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we are prepared to respond. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation back down to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Economy.
Even though other central bankers often say that they don't follow the Fed, they often implicitly have to.
The Fed's leaders see a slowdown coming in the U.S. job market.
The time has come for policy to adjust.
The time has come for policy to adjust is the quote that's been heard around the world.
Those changes can alter how much dollars are worth in the United States and beyond.
There's a huge trust factor, and therefore the dollar is seen as the world's reserve currency.
So how did the Fed become the world's most powerful central bank? And what do its upcoming decisions mean for the global economy? The U.S. economy, guided by the Fed, is the largest in the world.
The U.S. economy's stature is one of the key drivers of the importance of the Fed, given that the U.S. economy remains one of the largest economies in the world, and certainly of late, one of the ones that's been fastest growing.
A country and its currency doesn't become important and the world's most important currency overnight. The value of the currency depends a lot on the economy. If the economic conditions are right, there's economic growth in the region, then the currency will also appreciate and do well.
From 2022 to 2023, interest rates controlled by the Fed rose to over 5%. Many central banks around the world did the same, making loans more expensive and slowing economic development to halt a global bout of inflation.
Everybody took the elevator on the way up, tightened monetary policy very rapidly. The Fed was at 5.5%. Most other central banks were either close to or slightly lower to the Fed's policy rate, certainly across advanced economies.
Higher interest rates can increase the value of cash.
If interest rates are high, relative to other countries, the dollar is appreciating.
Higher interest rates also make it more difficult to receive raises at work. This can prevent escalating bouts of inflation that economists call wage price spirals.
The Fed has managed the currency for a long period of time in a way that is supportive of a strong dollar. So they will tend to cut off any threat of wage price spirals, and they've done that for a long period of time.
The Federal Reserve manages those interest rates based on what they see is happening in the labor markets and inflation.
By the end of summer 2024, signs of an economic slowdown appeared in the US, prompting central bankers to consider reductions in interest rates.
As the Fed lowers its rate, it's going to get closer to other central banks' interest rates.
Changes to the Fed's interest rate can disrupt stock market trading techniques too.
And that's really what we saw in early August, where we had this sudden global market sell-off that initially started off of a weaker than expected payroll report in the US.
The cooling in labor market conditions is unmistakable.
We still had job growth that was positive. We had a slight increase in the unemployment rate. What happened was that it was weaker than expected.
The weak labor data led investors to abandon a popular strategy called the carry trade. Here's how it works.
You borrow in a currency that is cheaper, undervalued, and then you invest in a higher yielding currency.
For example, an investor might borrow money in Japanese yen to buy US assets, like the 10-year Treasury bond.
When a carry trade is working well, that means the value of my dollar assets that I've just purchased are appreciating compared with my yen borrowing that I've used to finance the trade.
But that strategy can backfire.
If the Fed is all of a sudden expected to cut